Welcome to another episode of Stately Investing with your host, Burnett King. If you like the content I'm putting out there, give us a thumbs up. If you love the content I'm putting out there, give us a subscribe. It really helps the channel. If you have any questions, feel free to leave them in the comments section or send me an email at statelyinvesting@gmail.com. And let's get started with the show. So today we're talking about REITs and exactly what is a REIT, what types of REITs are they risky investments, and what I think about each category. So a lot of people like REITs for their dividend growth strategy because REITs are, at least in the US, forced to pay out most of their income in the form of dividends, right? So if we look at this article, and I'll put a link below, you guys can check it out here. It's a pretty nice article on like what are REITs and how to invest in them from US News and World Report. So a REIT is a real estate investment trust, right? Meaning that this company owns or operates real estate, right? And the real estate then is paying them money. They're essentially like a landlord, and then they make money from their tenants, and that money then gets paid out through dividends to the people that invest in these companies. So overall, there's really, like they say here, there's two broad categories of REITs. There's the equity REIT and mortgage REITs. And equity REITs are those who actually like operate and own the real estate. As you see here, things such as apartment buildings, offices, or shopping centers. That's what typically people think of as REITs. There's another type of REIT in mortgage REITs, and these are people who are or companies who are responsible for financing real estate and making money off of the mortgages, right? And so those are the two main types. But this article also talks about some other more obscure or niche types of REITs, which are interesting. And I do own a couple of these types. So lodging and resort REITs, which is interesting, right? These are hotels, resorts, kind of bigger commercial properties, self-storage REITs, self-storage facilities, data center REITs, which are also interesting, right? These are data storage and server farms, those kind of places. Infrastructure REITs, which are things like cell towers, utilities, pipelines, that kind of thing. Industrial REITs, these are distribution centers and warehouses. And then timberland REITs, which are REITs specifically around harvesting and selling timber. So I'll go through each of these categories again and just tell you whether or not I think they're risky. So I think equity REITs, the typical REIT that you think of, I think are risky right now, right? And I own two of the larger equity REITs. But overall, I would say equity REITs tend to follow the real estate market, right? And so if your tenants can't pay their rent, which we were seeing in previous months, you can check out one of my videos on the Cheesecake Factory and other businesses that cannot pay their REITs or pay their rents. You can tell that it's risky, right? So as the economy goes down or people are losing their jobs, it's much harder to pay your rent, and therefore these landlords don't make as much money, which means they probably have to cut their dividends, right? Because the majority of their income goes to paying dividends, and so if they're not making income, then how can they pay those same dividends? So I think equity REITs are risky right now. So my advice is to look at some of the bigger equity REITs and make sure that you're investing in ones that have a strong financial background. And typically that's indicated by size, but not always. So in M1, you can do some research, go to stocks. They're typically always in finance. And then I picked one where you can actually search for real estate investment trusts, right? So that's these 204 companies here that M1 does trade in. And then you can search by market cap. So you can see the biggest companies towards the top. I do own some of these companies. I think actually some of these are fairly risky, even though they are large. So I would highly encourage you to investigate on your own and understand what that company's business model is and whether or not you think it makes sense for your portfolio. So the second category is mortgage REITs, and I think these are even more volatile and more risky. in good times, these pay out huge dividends. It's a solid plan when the economy and the real estate market is doing well. But I think we are in for a turn. Not to sound negative, but I think mortgage REITs, unless you are in finance or real estate and really understand the business model of what that REIT is doing, I would not encourage you to invest in mortgage REITs. It just takes a level of financial knowledge that I'm not comfortable with, but maybe you are. So again, my advice, and you'll hear this over and over again, is to investigate each REIT independently and understand what they're doing and whether or not it makes sense for your portfolio. But overall, I would say right now, mortgage REITs are very risky, probably the highest risk of all of these categories. Lodging and resort REITs, again, I would not necessarily touch right now, although they're probably at low pricing or low prices. So you might want to investigate specific ones and find out specific opportunities that have really high yields right now because their stock prices are low. But overall, I think these will follow the real estate trends as people have less money to spend on hotels and travel. This is a category that I would also avoid. I don't think, for me, it's not a long-term investment because I couldn't just leave my money there and leave it, right? Like I would have to actively figure out when to buy and sell. And that's typically not something I'm doing with my dividend growth investment portfolio. I think lodging and resorts are too cyclical. Self-storage, I think, is a very safe category. I think, I own Public Storage, one of the biggest self-storage REITs. If we go over to M1 again, you can see Public Storage here is huge. I think it is a pretty solid company. Personally, that's why I invest in it. And I think people's self-storage needs are only going to go up as the world continues to buy more and more things and just consumerism happens. They will need to pay for their storage. And I think people are actually more willing to pay for their storage because they don't want to lose their goods. Public storage has a very high occupancy rate. It's something like 95 to 96% of their storage facilities are occupied. And additionally, people are more willing to pay that rent essentially than even their own rent. It's similar to cars, right? Car loans people tend to pay off their cars before they even pay off their rent or their mortgages because they need that to function. And people see all of this stuff that they have in their storage as something that's essential to their lives. And so they tend to keep that as well. The next category is data center REITs. I think this is another the high growth area. So probably not as stable as self-storage, but also not very risky. I think this is a great investment opportunity, a place where there are probably a lot of good REITs out there, unknown investments where you can make a lot of money because our data needs are only increasing and businesses that own these types of properties will only be growing in the future. Infrastructure REITs are probably pretty safe, especially with cell towers. I think cellular technology is not going anywhere. We have 5G coming along, so there will be an investment in upgrading towers and upgrading the technology, and these REITs are poised to make great returns. Industrial REITs, I think, are a little more stable, similar to self-storage REITs. Distribution centers and warehouses, again, these are connected to kind of consumerism and, businesses as they grow, they're going to need distribution centers and warehouses. It might be a slow time for them, but not a bad place to invest your money. And then timberland REITs, I think, are a very specialized sector, and I don't know a ton about them. I think, again, you should investigate those on your own on behalf and figure out whether or not the specific company is something worth investing in. I just can't give you advice on them because I don't know enough about it. So overall, I think it really depends on the type of REIT that you're looking at. I would suggest, mixing up your portfolio. You can see in my holdings, let's go back to my accounts here. I own several REITs. The REITs that I own are actually on the thumbnail, so you guys can check them out there. But you can see overall I own Store Capital. I own, Crown Castle. Crown Castle is another interesting company. You should check them out. Public Storage, I own, as I mentioned, Realty Income and then equity lifestyle properties. Equity lifestyle properties is kind of a niche within the equity REIT, where they specialize in healthcare facilities and like senior living, which is typically a growing market. But again, right now they're probably priced really well because of the coronavirus. So there might be some opportunities in the like senior living space as well. So I would say check that out. But overall, like I said, try to own a mix of REITs so that way you're not exposing yourself to one particular type of real estate. And that would be a good way to kind of get involved and get started. There are certain sectors I would avoid right now, like mortgage REITs, and lodging and resorts in particular. I think there's a good mix across the other types. So we're going to jump into the portfolio here soon. But feel free to give me a thumbs up if you understand more about REITs, or if there's something I missed in the video. I'm still learning. I would love for you to drop a comment about REITs or other stocks that you particularly own or think are good values. So let's go over to the portfolio. Overall, you can see I'm up to 14,894. We've almost gotten back to neutral territory. So overall, if you look at the overall picture, the market gain is now down to only negative 285, and my earned dividends are up to positive 269. So we're almost neutral here, only down $16. You can see where the big dip started occurring and slowly climbing our way back up, right? And this might look like a bigger gain than it is, but remember, I'm also investing as this time period is going on. So you can see the net cash flow, right? This is how much I put in, and I've lost $16 on that. If we look at return and earned dividends, let's go into the weekly view. So the week was pretty flat. There was this kind of gain towards the beginning of the week, and continued to be mostly flat. But overall, about 4% up, which is not bad. Most of that is due to market gain. So if we look at activity, you can see there's very little going on with my dividends this week. A lot of activity in the last 2 weeks, but not so much this past week. Next week, we'll look at the monthly analysis and see overall how much I gained for the month. But not a ton of dividend activity, but nice to still see the dividends growing. And we can look and see there were no real sales here, 32 buys. This was on Monday of the past week. Big purchases in P&G, Johnson & Johnson, Gilead, Coca-Cola, fairly big in Kimberly-Clark. So overall, it looks Pepsi, looks like, consumer packaged goods seems to be where I need to invest, and where M1 was buying for me. So that's good to know. But overall, a pretty solid week. We'll see how the activity holds up over time and whether we see this secondary dip, with the given unemployment rates and just the economy, and seeing, when the effects of the treasury will start to wear off. But overall, not bad. Hopefully this will continue to go up. But if not, remember, our strategy is in dividend growth and just picking great companies. So hopefully you guys learned a lot from this video. Feel free to like, subscribe, tell your friends, tell them to check out the channel. I appreciate all the views and the comments, and I will see you again next week.